The number one question in retirement is, am I going to be okay? And so what we're going to walk through in today's video are 3 investments and particularly how that impacts your retirement. Now, as a reminder, I'm Ari Taublieb, a financial planner, and I help people retire early. So let's hop right in, and I'm actually going to be using the iPad for this video to work through it with you, and I'm going to pretend that there's 3 investments right now. You tell me which one sounds best to you. So number 1 is there's an investment, and that investment goes up 53% of the time. Now there's another investment, option 2, that one is going to go up 65% of the time, and then there's an option right here that is number 3, 75% of the time. Which one would you choose? And people pause. They go, Ari, I'm not an idiot. I'm picking option 3. Clearly that one is the best of the ones provided. And what I tell people is option 1, 2, and 3 are all the same exact investment, which is the returns of the S&P 500, the 500 largest companies in the US. And so why do we look at this? We look at this because option 1 goes up 53% of the time. Option 1 is the stock market on a daily basis. 53% of the time, the stock market goes up on a daily basis. 47% of the time, the stock market goes down. Now, option 2 is exactly the S&P 500 on a monthly basis. So odds are you're going to make money if you just go invest in the S&P 500, but 35% of the time on a monthly basis, you lose money. Now, option 3, that is an annual basis. So 3/4 of the time, you are going to make money, but 1/4 of the time, you are not going to make money. And all this is a basic example to understand how should this even impact the way I'm investing in retirement? Well, here's why. Let's go out a little further. Let's look beyond these 3 investments. What about on a rolling 10-year period? So look at any 10-year period of the S&P 500, and it's up just about 90% of the time, which is helpful guidance. Now let's look at it on a 20-year rolling time period. On a 20-year rolling time period, the stock market has never not made money. Meaning 100% of the time, it's always gone up. Does that mean it will always continue to do so? No, we can never guarantee it. But when you're thinking about investing, when you're thinking about how should I be invested throughout retirement, there are 2 major risks that we want to think through. Risk number 1 is the risk that you're likely very aware of today, which is that it is not fun when when the money that is in the market goes up and down, but that's the short term. Meaning, although it's not fun when markets are doing what they're doing, like right now, that's a very real risk, and if you needed this money to live off of, well, we don't want to invest it all for growth. We would be missing the point, because the last thing we want in retirement is to have to be invested. The money goes down, and now we need to take these funds to go live off of, and we're realizing a loss. We're losing out on our investments. And so what we will look at is this risk, but the second risk that most people do not even consider is what is called purchasing power risk. And excuse my handwriting here, but purchasing power risk is the major risk that we look at as planners, which is the risk that you run out of money. How do we protect against purchasing power risk? We need to be outpacing inflation. So how do we do that? Well, there's a few different options. Number 1 is you could own something called TIPS. What are TIPS? These are Treasury Inflated Protection Securities. So it's a way to be protected by owning investments that seek and hope to maintain that inflation adjustment. Now, that's one way, but another way, quite simply, is through owning stocks. A basic example of this is when you're owning stocks, you are literally owning a company. And so as Apple increases their prices, as Amazon increases their prices, as Ford increases their prices, how do we participate in combating inflation? We own the companies that are indeed raising their prices. So by owning stocks, as opposed to just an inflation hedge, we're actually outpacing inflation. And so if we look on just a very broad scale of what stocks do compared to what inflation has been, stocks on average go up 5.5% more over time, and that's a real return. And so a real return is meaning after inflation, what are we really getting? 10% is the historical average of the S&P 500, but what's the real return after inflation has been factored in over many, many, many years? Well, 5.5% is that return. So if you were to be investing and just pacing with inflation, you're not exceeding it, but you're just staying on par with it, well, your money's not really gaining value, it's just keeping its value. And so what we want to know is, what should we do, which is the number question, to be okay? And what we always want to think about is, what is the right mix for you? Meaning, there might be investments, there might be a pension, there might be Social Security, there might be inheritance. There's so many factors when it comes to retirement, but particularly with your investments, what we want to think about, and by the way, comment below if you do want to retire early. Comment financial freedom. Comment financial freedom. That is really when you are in the position to be financially free. When you no longer have to worry about money because you have a plan. Now, when markets are doing what they're doing right now, it's not fun. I will be the first to recognize that. When you see you have $1 million and it's going down by hundreds of thousands of dollars, it is not a fun experience. But as a planner, I want to make sure that your money is outgrowing inflation so that as groceries go up, as gas goes up, as all of these things are occurring, you are far outpacing it and can do more of what you want to do. So to summarize, when people think about the stock market, you want to think about your time horizon. Are you investing for the next 2, 3, 4, 5 years? Or are you investing for the next 10, 15, 20, 30 years? Because we could certainly not go through the ups and downs of the stock market, and it might even feel really good to do that for the next year or so. But now if we look out 5, 10, 15, 20 years later, well, all of a sudden we're going to be kicking ourselves because we know that over time, the stock market is the best way to grow our wealth. Well, you could have a certain amount in cash. You certainly want that so that there's comfort there. But if you have too much in cash, then we start to lose out and our money actually goes down in value. You don't see it. That's why it's known as the silent killer, but it's inflation that you're up against in retirement. And so some of my best clients don't even check their account. They go, Ari, I have a client last week who said, Ari, I forgot my password. I haven't checked in. How are my investments doing? Now, the reality is their investments were doing well, not because they're a genius, not because I'm a genius, but because I am capturing the market in a way for that client to provide income throughout their lifetime. If the client said, Ari, I think we should try timing the market, or I think we should try getting in at this time. Well, now we're subjecting ourselves to market timing, which is one of the surest ways to make sure that you are not optimizing your income in retirement. So the 3 best ways when we look at in retirement investing, don't think about the daily ups and downs. Don't even think about the monthly ups and downs. Don't even think about the annual ups and downs. On average, the market goes up and down about 10 to 15% every single year, but it still has a historical average of 10%. So don't worry about the little ups and downs. Those always will occur. The reason that you invest is because you want your money to grow for you. If you are not outpacing inflation, well, our money is then just automatically losing value. We are guaranteeing it. So when you are investing for retirement, you want to think about, how can I make sure I have money throughout the rest of my lifetime? And building multi-generational wealth is also a giant factor for many people. How do you do this? You invest in stocks. You invest in the companies that grow most over time. So that's it for today's video. If there's someone you want to retire with, share this video with them so you can travel with them, so you can spend time with grandchildren, so you can do more of the things that you want to do. As always, subscribe. I'm putting out more content just like this every single week. And I also have a podcast on a separate channel where I'm doing full episodes on how to retire early. So that is it for today's video, and I will see y'all next time.